Yes. Question number 1, that is the compulsory question, guys. 15 marks question. 15 marks question. So, before reading the information given in the question, let us read the requirement first. What is it? You are required to compute the total income and tax liability of Mr. Prakash under both the regimes and suggest the one which is more beneficial to him for the assessment year 26-27. Assuming he has never opted for default tax regime since the relevant assessment year, means in the past he has never chosen default regime. Okay, but now they want you to calculate the total income and tax liability under both the regimes. So totally you are supposed to do 4 calculations, guys. Total income and tax liability under default and total income and tax liability under optional. So totally 4 calculation, a lengthier question, but we'll see what is the information given. Mr. Prakash, a resident individual, aged 64 years, very important. Yes. Why? Because in the answer, in one or the other place, it will play a major role, guys. Especially under optional scheme. Because the under optional scheme for a senior citizen who is aged 60 or more and resident in India, the basic exemption limit will be 3 lakh while computing tax liability. Is in the business of manufacturing tires. Yes, this is also important. He prepare his accounts on mercantile basis. Okay. His statement of profit and loss showed a net profit of 1 crore 20 lakh for the year ended 31st March 2026 after debiting and crediting the following items. Okay, so this would be our starting point, guys, to compute PGBP income. Okay, so the following items has been debited and credited to P&L account already. So we need to decide whether we should add back, deduct it, or just leave it like that. Okay, sir. First one, depreciation as per books, we need to add it back. We need to calculate as per section 32 and we will deduct that. Okay, next, interest paid on loan taken from a scheduled bank to buy pollution control equipment. See point 3 in addition information. Okay, we will see it. Amount of loan 8,52,000 at 10% per annum, which was taken on 1st June 2025. Entire interest paid was debited to statement of profit and loss. Okay, whatever it is the interest on loan to purchase an asset has been debited to P&L. Okay, so they're asking us to refer the third point. We will just refer it and then go back. He also imported an air pollution control equipment falling under 15% block, which was previously used outside India by the seller at a cost of 10 lakh on 1st June 2025. Guys, as it is already used outside India, no additional depreciation on it. Even though it falls under plant and machinery block, even though assessee is engaged in the manufacturing business, no additional depreciation. Please be careful. The additional depreciation is only on new plant and machinery. Okay. For this purpose, it took a loan from a scheduled bank amounting to 8,52,000 at an interest rate of 10% per annum on 1st June 2025. The equipment was delivered on 15th September 2025 and was put to use on 1st October 2025. Okay, put to use date is important. Guys, if a loan is taken or borrowed for the purpose of purchasing an asset, whatever interest is paid up to the date the asset is put to use has to be capitalized as per section 43 subsection 1. As per section 43 subsection 1. Yes, sir. So how much interest has to be capitalized? Amount of loan is 8,52,000. Yes, sir. Interest rate is 10%. Yes, sir. Date of loan is what? 1st June 25. And put to use on 1st October. So, date of loan is 1st June year. Okay, 1st June 2025. June, July, August, September. So, for 4 months, interest has to be capitalized, guys. For 4 months, interest has to be capitalized. Remaining interest, that is from October, November, December, January, February, March. This can be claimed as an expenses. That is revenue expenses. But here, they told entire interest expenses has been debited, it seems. So what should we do? Whatever we will capitalize, no, that part we need to add. That part we need to add, not the entire interest. Only that 8,52,000 into 10% into 4 by 12. Only that part which we are adding to the cost. We will claim depreciation on the increased cost, right? Yes. So that part has to be added here. Okay, that is 8,52,000 into 10% into 4 by 12. That is the interest component which is capitalized. to calculate the cost of an asset. Section 43 subsection 1 talks about the actual cost of an asset to add it to the block, guys. Okay, sir. Fine. Next. Purchase of raw materials includes an amount of 1 lakh towards purchase made from micro enterprise. Okay, micro enterprise, important. As per section 15 of Micro, Small and Medium Enterprises Development Act 2006, the purchase was made on 1st February 2026, but the payment was made on 20th July 2026, next financial year, within the due date of filing the return of income. Okay, but that is not important for us. There was no agreement as regards the payment terms with the seller. Guys, when there is no agreement, payment has to be made within how many days? 15 days of receiving the goods or services. So here, the date of transaction, the purchase was made on 1st February, but payment is made on 20th July after 15 days. So can it be claimed on accrual basis? No. It will be allowed, but on payment basis. But what is the year of payment? The financial year 26-27. That is next financial year. So can we claim it in the current year? No. We need to add it back. We need to add it back. I will just show that provision in PGBP chapter 43B. You can just come to 43B. Guys, please be careful. Under section 43B, there are number of items covered for the following expenses. For the following expenses, it is not allowed in the current year if it is not paid within the due date of filing the return of income. Whereas for the payment made to micro and small enterprise, the time limit is different. They tried to confuse you by giving that also. They told that it is paid in July within the due date of filing the returns. But is it relevant for this payment? No. Because the payment made to micro and small enterprise is covered under section 43BH, for which the time limit is different. When there is no agreement, payment has to be made within 15 days of accepting the goods or services, guys. In the given case, it is not made. Hence, disallowed. Hence, disallowed. Yes, sir. Next. Interest of 2,50,000 gross on enhanced compensation on compulsory acquisition of his factory building by the government based on a court order. However, he actually received the amount in his bank account on 20th May 2026. Guys, listen, interesting. 2,50,000 is the interest on enhanced compensation. Interest on enhanced compensation. Interest on compensation or enhanced compensation received because of compulsory acquisition will be taxable on receipt basis in the year in which it is received. Sir, assessee is following mercantile basis or accrual basis, doesn't matter. Doesn't matter. Interest on compensation or enhanced compensation will be taxable on receipt basis under the head income from other sources. And there is also a flat deduction of 50%. But in this case, it is received on 20th May 2026, that is next financial year. So in the current financial year, is it taxable? No, sir. It is not taxable. So what should we do with this? Deduct it. Already it is credited, so profit has gone up, so deduct it, guys. Next, 50,000 given as contribution through an account pay check for a brochure of political party actively working in a vicinity of a factory and registered under section 29A of the Representation of Peoples Act 1951. Guys, this is also disallowed. As per section 37(2)(b), it is disallowed. As it is not related to the business, we cannot claim it as business expenditure. And it is already debited, so add it back. Next, 2 lakh received as dividend from Indian companies during the year. This is taxable under IFOS, guys. So as it is already credited, what should I do? Deduct it. And credited to P&L account. Interest of 65,000 was incurred on loan taken to earn dividend income has been debited to statement of profit and loss account. All dividends were below the ambit of TDS provision. Means TDS is not deducted. Okay. So they have received 2 lakh, no sir, more than threshold limit. Yes, but it might be from different companies, no? Yes. And 65,000 is already debited, guys. So what should we add back? And what should we do with this? Add it back. Why should we add it, sir? Because both of this, we will consider it under IFOS. But under IFOS, sir, is entire interest allowed? No. Dividend income is 2 lakh people. So what is allowed as interest is actual interest of 65,000, correct? Or 20% of dividend income, which comes to 40,000. So whichever is lower, whichever is lower, whichever is lower, which comes to 40,000. Remaining 1,60,000 would be taxable under IFOS. Hope you understood. Interest expenditure on dividend is restricted to maximum 20% of dividend income. So in our case, dividend income is 2 lakh, 20% of that comes to 40,000. But actual expenditure is 65. So can I claim full 65? No. Sir, can I claim that remaining interest under any other head? No, not allowed, guys. Okay. Coming to additional information. So whatever is being debited and credited, we are done with it. Now additional information. First one. He had taken a housing loan from a scheduled bank for purchase of flat for self-occupation. Okay. On self-occupied property. On 1st April 2025. Interest of 2,15,000 and principal repayment of loan of 1,10,000 is reflected in his bank statement. Municipal tax of 20,000 was paid during the year from his savings bank account. Okay, guys, important. As it is self-occupied property, municipal tax paid is not allowed as deduction. Because for self-occupied property, GAV will always be nil. Only thing which assessee can claim is the interest on housing loan. That too under optional scheme. So, interest on housing loan is allowed under section 24B. Principal repayment is allowed under section 80C, but both only under optional scheme, guys. Both is allowed only under optional scheme. Sir, what if assessee is following default scheme? Then both of them is not allowed. Interest on self-occupied property, not allowed. Principal repayment of housing loan deduction under section 80C, not allowed. Hope you got it. Yes. Next, second point. A new machinery costing 50 lakh, first machinery in 15% block, was purchased on 1st September 2024, last financial year. It was installed and put to use on 24th October, important date. Why, sir? Less than 180 days. Less than 180 days in the last year. Not in the current year, last year. It did not own any other depreciable asset on the date of acquisition of this machine. Guys, interesting. See, on the new plant and machinery purchased and put to use in the factory, additional depreciation is allowed. This is new, please be careful. The next one, that is the air pollution control equipment, that is second hand. On that, additional depreciation is not allowed. Whereas on this new machinery installed in the factory, can we claim additional depreciation? Yes, but only under optional scheme, 20%. But observe, last year, assessee was following which scheme? Optional scheme. Because he never followed default scheme in the past. That means in the last year he was following optional scheme. Yes. Did he claim additional depreciation? Yes. But how much? As the asset was purchased and put to use for less than 180 days in the last year, he would have claimed less than, as it is less than 180 days, he would have claimed only 10%. That is 50% of 20% is 10%. Remaining 10%, can he claim in the current year? Yes, but only under optional scheme. Whereas under default scheme, it is not allowed. Hope you guys got it. Under default regime, normal depreciation is allowed, but not additional depreciation, guys. Be careful with it. Yes, sir. Okay. Third point, we already read it, guys. We'll move forward. Fourth one. During the financial year 23-24, the central government compulsorily acquired factory building which had been used by him for manufacturing rubber products for the past 5 years. Guys, the year of transfer is 23-24. But in case of compulsory acquisition, as per section 45 subsection 5, it will be taxable in the year in which the compensation is first received. Even if it is received in installment, whenever you receive the first installment, it will be taxable. Yes, sir. Correct. He received compensation of 20 lakh on 15th March 2025, last financial year again, and deposited the whole amount in the capital gains account scheme within the due date of filing the return of income. The building was purchased by him for 5,08,052 on 1st April 2018. The return down value of the building block as on 31st March 2023 was 3 lakh. He has shifted the production to a leasehold building till the purchase of new factory building. Guys, this story is irrelevant for us. Sir, why, sir? So big paragraph they have given, you are telling irrelevant? Yes, because transfer happened in the year 23-24. Yes. And the installment or compensation is received in the year 24-25. Yes. So when is capital gains taxable? In the year 24-25, guys. So our current previous year is what? 25-26. So should we be bothered about this compulsory acquisition? No, guys, because it is already taxed in the last year when the compensation is received. Even if it is received in the installment or 20 lakh, let us consider the entire amount is 20 lakh, still it will be taxable only in the last year, guys, on receipt basis. This is as per section 45(5) when there is a compulsory acquisition. Yes, sir. So entire story is irrelevant here for our previous year. Next, on 1st April 2025, Mr. Prakash purchased a new factory building which is falling under section 10% block at a cost of 15 lakh. On this, can he claim depreciation? Yes, as it is a factory building, he can claim 10% depreciation, full depreciation, as it is used for more than 180 days. Then cost inflation index for financial year 23-24 and 25-26, they are given, guys. This is again irrelevant. Please be careful because student would have calculated capital gains and unnecessarily wasted time on it. Yes, actually, I am concerned. This is okay. There is no mistake in this, but especially in MCQ, there was one mistake, no correct option. But I am concerned about the students who wrote the exams in May. Why? Because they would have spent time in reading that question, solving it, and once they get the answer, they are not finding it in the option. They will cross check again and again. They will see where they have gone wrong. They would have spent good amount of time on it. But later, if ICI come up with telling no correct option, then whatever time they have spent in the exam, that crucial 3 hours, can they get it back? Definitely not, guys. I really feel sorry for those who would have written May 2026 exam and spent too much time, especially on that particular question. That is that capital gains calculation in case of slum sale. Yeah, chal, fine. We'll continue. You are required to complete so and so. We already finished. By guys, one thing they have given here, please be careful with this. They never opted for default regime itself. Means in the past they were following optional scheme. Now in the current year, sir, can they come because they have business income? Can they come to optional? Yes, guys. For the assessee who has business income or income under the head PGBP, from default scheme they can go to optional scheme. They can continue under optional scheme. And can they come back to default scheme? Yes, but they can never go back to optional scheme again. So now, assuming they are under optional scheme for the first time, they are continuing with that. If they want to in the current year, can they come to default scheme? Yes, they can come. But in the current year, if they come to default scheme, can they go back to optional scheme in the future? No. Hope you understood. Yes, because they are asking us to calculate under both the regimes. So will it be relevant? Yes, it will be relevant. And also they are asking us to suggest which is more beneficial. Wherever the tax liability will be lower, we will suggest that as more beneficial, guys. Yes, chalo, we will see the answer. Computation of total income and tax liability of Mr. Prakash for the assessment year 26-27 under the default tax regime. Under default tax regime. Under section 115 BAC. Okay. Guys, income from salary, nothing is there. Straight away we'll go to income from house property. Interest on self-occupied property is there, but under default regime it is not allowed. So straight away income from self-occupied property would be nil under default scheme. Yes, sir. Next, profits and gains from business or profession. Okay, better to do this as a working note, guys, because too many calculations would be there here. I would suggest the student to do it as a working note. Yeah. So the starting point would be 1 crore 20 lakh, which is given at the top of the question. Items of expenditure not allowable while computing business income. Depreciation as per book, add back. We will calculate as per section 32 later. Interest on loan for acquisition of pollution control equipment till the date the asset is put to use. We need to capitalize it. As we are capitalizing it, we are adding it back here. Okay. How much is that, sir? 8,52,000 into 10% into 4 by 12. From date of loan till the date the asset is put to use. So it comes to 28,400. Add it here. Same thing should be added to the cost of the asset. Okay. So we are disallowing here and we will add it to the cost of the asset to claim depreciation. Then payment to micro enterprise, as I already explained this. As the payment is not made within 15 days, it will be allowed on payment basis, but in the next financial year. So in the current year, add it back. Next, expenditure in the brochure of a political party as per section 37 2B. This is disallowed, not related to business. Yes, sir. Then interest on loan taken to earn dividend, we will consider this under IFOS. It is not allowed as business expenditure, so add back that also. So the total addition comes to 12,43,400. Okay, sir. They have also done it subtotally. Oh. Next, less items credited but not taxable or taxable under other heads. Interest on enhanced compensation on compulsory acquisition. This will be taxable, but in the next year, guys. So remove that on receipt basis. Next, dividend from Indian company will be taxable under IFOS. So remove it. 2 lakh. So total deduction is 450. Anything deducted, better put it in bracket. 4 lakh 50. Okay. Next, depreciation. This is one of the important adjustment, guys. Depreciation as per income tax rules. That is as per section 32. You can also mention the section. They are not given the section, but you guys can mention 32. Depreciation on machinery purchased in 24-25 last year. First, we need to calculate what is the opening WDV. Important. Guys, opening WDV. Where is it? Yeah, they have taken it here. Actual cost is 50 lakh as on 24th October 2024. Now tell me, last year the asset was put to use for how many days? Less than 180 days. Less than 180 days. Correct? Yes. On or after 4th October. Hope you remember the date, 4th October. Yes. So it is after 4th October. So it is less than 180 days. Yes. So last year they would have claimed a normal depreciation as well as additional depreciation. Sir, why additional? We are doing a default regime. Guys, we are doing default regime calculation and for the current year. But in the last year, did they follow optional scheme? Yes. That last line of the question I read again and explained. Yes. So as last year they have followed optional scheme, they would have claimed additional depreciation, but only 10%. Only 10%. Okay. Fine, sir. For last year, should we reduce both normal depreciation and additional depreciation? Yes. So actual cost is 50 lakh. Normal depreciation is 15%, but 50%. 15 actual rate, but 50% of that, which comes to 7.5%. Yes, sir. 3 lakh 75. And additional depreciation, guys, this is also very important because normally student might miss out this. As we are doing default regime calculation, sir, here in the heading we gave default regime. Yes, for the current year we are doing the calculation under default regime. You guys are right. But here we are calculating the opening WDV for this asset. While calculating opening WDV for this asset, last year the assessee followed optional scheme. He would have claimed additional depreciation. So should we reduce it? Yes, we should reduce it. Please be careful, guys. Maybe those who have written May 2027, May 2026 exam would have missed this part, but please be careful with this. Additional depreciation for previous year 24-25, that is last year, when he was following optional scheme. How much is that? Actual cost into 20% is the rate of additional depreciation, but as the asset is put to use for less than 180 days, only 50% of it, which is 10%. Which is 10%, comes to 5 lakh. 5 lakh. Yes, sir. Both of this has to be reduced. So what was the closing WDV at the end of last year? It is 41 lakh 25,000. That becomes opening WDV for the current year. Yes. So on this, we will claim depreciation in the current year. And please be careful. This is for last year calculation. Can we claim it in the current year? No, no, no. I just wanted to find out this figure. That is why we did this. Hope you got it. So using this, we will claim current year depreciation. So on 41 lakh 25,000 into 15% in the current year, full, guys. Full. Okay, please be careful. This is the depreciation for the current year. This part, this figure. Normal depreciation. Sir, what about additional depreciation on this? No. Sir, last year only 10% was claimed. So that means remaining 10%, which is again 5 lakh, we need to claim in the current year, but only under optional scheme. As we are doing the calculation currently, right now, under default regime, this 5 lakh will again not be allowed in the current year, guys. Please be careful. Remaining 10% actually will be allowed in the subsequent year, but only if the assessee is following optional scheme. Hope you understood. Hope you understood. I repeat, I will repeat this. Guys, for last year, we reduced both normal depreciation and additional depreciation in order to know what is the opening WDV. While calculating the opening WDV for the last year, we reduced additional depreciation also because the assessee was following optional scheme in the last year. But in the current year, can you claim additional depreciation? No. Sir, in the current year, the asset is already old, no, sir? Yes. But in the last year, they claimed only 10%, no? That is 50% of 20% comes to 10%. Yes, which is 5 lakh. If the assessee was continuing under optional scheme, then you would have claimed 5 lakh even in the current year. Under optional scheme, it will come, but not under default scheme. So under default scheme, only normal depreciation, guys. This is ND, normal depreciation. Hope you got it. Yes. Next, depreciation on air pollution control equipment. 10 lakh is the cost plus the interest part which we are capitalizing as per section 43 subsection 1. Add back that. Clear? We disallowed it earlier, no? Yes. So that one we need to add here. So the total cost of this asset comes to 10 lakh 28,400 on that 15%. Sir, what about additional depreciation on this? Not allowed due to two reasons. One, first thing is it is not new plant and machinery. It is a second-hand plant and machinery. Whether it is used in India or outside India doesn't matter. No depreciation on second-hand machinery. Okay. And moreover, we are under default regime. So due to these two reasons, it is not allowed. Sir, under optional scheme, is it allowed? No, because it is second-hand machinery. No, not allowed. Okay. So 1,54,260 and factory building is purchased. At the end they have given 15 lakh into 10% claim depreciation. Additional depreciation is not allowed. That is, they have given here balance additional depreciation because last year we had claimed only 10%, but not allowed under default regime. Yeah. So the total comes to here 9,23,000. So what is the business income, guys? 1 crore 18,70,390. Hope you got it. If you want, you can go back and check again if you have any confusion in any point. Coming to capital gains, not taxable, guys. Not taxable. It would have been taxed in the previous year, 24-25. So in the current year, not taxable. Then income from other sources, interest is not taxable. It will be taxable in the next year on receipt basis. Then dividend from Indian company 2 lakh and interest maximum 40,000. This calculation I have already shown. So remaining is 160. Take 160 to the outer column. So gross total income is 1 crore 20 lakh 30,390. Deductions under chapter 6A not allowed. Okay, sir, should I mention like this and mention each section and tell not allowed? Instead of that, you can tell chapter 6A deduction is not allowed under default regime. Except 80CCD subsection 2, 80CCH subsection 2 and 80JJAA. But all these three is not there in this question. So no deductions under chapter 6A, guys. Okay. So the total income would be 1 crore 20 lakh 30,390. Now let us do tax calculation. So under default regime, the basic exemption limit is 4 lakh. So up to 4 lakh nil. 4 to 8 lakh 5% comes to 20,000. 8 to 12 lakh 10% comes to 40,000. 12 to 16 15% comes to 60,000. Then 16 to 20 20% comes to 80,000. 20 to 24 lakh 25% comes to 1 lakh. More than 24 lakh 30%. So do the calculation. 1 crore 20 lakh 30,390 minus 24 lakh. You will get this figure into 30%. Okay. So we are getting a gross tax liability of 31,89,117. And as the total income is more than 1 crore, even surcharge would be applicable. Up to 50 lakh, no surcharge. 50 to 1 lakh, sorry, 50 lakh to 1 crore, 10%. More than 1 crore up to 2 crore, it would be 15%. So in this case, it would be 15% guys. Default regime. Yes, sir. So 15% surcharge on gross tax, which comes to 4,78,368. Now add up both of this. Sir, should we check marginal relief here? No, guys. Total income has crossed 1 crore by a bigger amount only. That is 20 lakh is in excess of 1 crore. So please don't check it. Even if you check, you will not get it. Means you will not get means not marks. Marginal relief will be 0. Okay. Yes. But don't need to check because so unnecessarily don't waste your time. Then health and education says 4%. So tax liability comes to 38 lakh 14,184. Please round it off. As it is 4 less than 5, round it off to 180. As per section 288B, tax liability. Please do this without fail, guys. If not, you will lose at least half marks, half or 1 marks. Next, we will continue with the total income and tax liability calculation under optional tax regime. Sir, can we take the total income calculation as per default regime as a base? Yes, that would be a better idea, guys. If not, if you are starting from 0, you will consume too much time. Please better take the total income as per default regime as a base. Yeah, yes. So 1 crore 20 lakh 30,390 is the total income as per default regime. Make the necessary adjustments. First one, better take deduction later, guys. They have taken first deduction and then they have made an adjustment. Okay. Yeah, better I will do this. Balance additional depreciation on machinery purchased in 24-25. Additional depreciation. Last year only 10% was claimed. No. Last year we were following optional scheme. In the current year also, if I'm continuing with optional scheme, can I claim it? Yes. Next, additional depreciation on air pollution control equipment is not allowed because it is second hand. Then interest on loan for self-occupied property, is it allowed? Yes, maximum 2 lakh. And that will be the loss from self-occupied property. Can loss from self-occupied property be adjusted against income from other heads? Yes, but maximum 2 lakh. Here anyway 2 lakh, we can adjust it. Please be careful, it is under optional scheme. Yes, sir. Fine. Then deduction part. Deduction under section 80C for principal repayment of loan to bank is 1,10,000. 1,10,000. Yes. Interest also allowed. This is under section 24 subsection B, guys. Whereas principal repayment is allowed under 80C. Maximum is 1,50,000, but here anyway it is within 150. Claim it full. Then deduction under section 80 GGC not allowable in respect of expenditure in brochure of political party. You see, GGB is for Indian company, whereas GGC is for others. And here the assessee is not an Indian company. It is other than a company. Clear? So I guess it was Prakash, individual or sole proprietor. So for them, is 80 GGC deduction allowed for an expenditure in brochure of a political party? No, guys. Yeah. So 1,10,000 is the total deduction. Here also 7 lakh we need to reduce. So what is the total income under the optional tax regime? It would be 1 crore 12 lakh 20,390. Here also surcharge would be applicable. Yes, sir. So what is the basic exemption limit under optional scheme, guys? 2 lakh 50 or 3 lakh? 3 lakh. Please be careful. Assessee is a resident senior citizen. So the basic exemption limit would be 3 lakh, guys. So up to 3 lakh nil. 3 lakh to 5 lakh, it is 5%. Comes to 10,000. Then 5 lakh to 10 lakh, it is 20%, which comes to 1 lakh. So more than 10 lakh. So that is you do total income minus 10 lakh. You will get 1 crore 2 lakh 20,390 into 30%. You will get this figure. So gross tax liability will be this. Better you close the amount column here. If not, you will add that also. Better to close like this. Yeah. So gross tax liability is this much, sir. Should we add surcharge? Yes. As the total income is more than 1 crore but up to 2 crore, surcharge would be at 15% under optional tax regime. Same rate. Yes, sir. Take it. And 15% is on gross tax. Please be careful. Don't take it on income figure, guys. Applicability of surcharge depends on the total income. But the rate of surcharge has to be applied on gross tax. Yes, sir. Then health and education cess will be at 4%. So the tax liability is coming to 37 lakh 98,636. More than 5. So round it off to next 10 rupees. 640. As per section 288B. Total income has to be rounded off to nearest to 10 rupees as per 288A. Whereas tax liability as per 288B, guys. Okay. Then they have also asked the suggestion. See, after doing so much calculation, I know student will be like tired. But thank God I have completed this. Let me move forward. But don't forget this suggestion. They asked this also. And if you don't write it, at least after 1 mark, they will deduct it. Since the tax liability of Mr. Prakash under optional tax regime is lower than the tax liability computed under section 115 BAC, it would be beneficial for him to opt out of default tax regime under section 115 BAC for assessment year 26-27. Guys, he is already following optional tax regime actually. He will continue with it. Clear? Yes, sir. Fine. Done with question number 1, guys.